Hi, my name is Jessie, and today we are going to talk about dollar cost averaging. Dollar cost averaging, or DCA in short, is an investment strategy mostly used by long-term investors. The idea behind it is to invest the same amount of money with fixed time intervals. It does not matter which currency is used for investment as long as the value remains the same. Imagine John can invest $10 monthly and he wants to use dollar cost averaging strategy. The company, which stocks he wants to buy, goes at $2 per share, so he buys 5 stocks today. Next month the market goes up and the stock now sells for $5 each. John can afford to buy only 2 stocks, which he does following the strategy. The month after the stock goes down to $1 per piece. John now buys as much as 10 stocks of the company. Within these 3 months, John invested $30 for which he bought 17 stocks. This means he paid slightly less than $2 per stock on average. This strategy prevented John to attempt to time the market. While he could have bought 30 stocks at the bottom, he could have also bought only 6 at the top. Dollar cost averaging is aimed to be used for long-term investment. Short-term investment takes into account company share price rather than quality and value. Statistics show that it is extremely hard to time the market, thus any attempts possess some risk. Additionally, some investors may panic and try to quickly buy or sell their stocks with a bad timing. DCA is intended to minimize those risks by avoiding price fluctuations in the long run. DCA strategy is used by most pension funds and managed passive investment portfolios. Thank you for watching. Please, like this video and subscribe to my channel. See you in the next one. Jessie, power off.